I've been shot at. I have been peed on. If it has crawled or slithered, I have probably eaten it. I've made decisions that this other guy has never made, and I hope that he never will. Also mentioned I delivered a baby, too. You do all kinds of things with special ops, let me tell you. He looked at me. I never had an interview quite like that, but I looked at him. I could tell he had me. So he got on the intercom, never said a word to me. He says, "Faye, would you come in here a minute?" And I just thought, well, Dewey, that's real brilliant, you know. You know, you just may as well get up and walk out and don't let the door hit you in the butt on the way out. He says, "Faye, take Mr. Strickler to our personnel office. He is our new grain merchant." Whoa. Okay. You might ask or think, you know, how is spending 6 years in Special Forces, 7 years in Special Forces Reserve, how does that prepare you to do what I have done? As far as like being a commodity fund manager, consultant, it prepares you for the unexpected. When you go into Special Forces, they look for three things. They look for above average intelligence. I slipped in underneath the radar. They look for high level of testosterone, and when you're in your 20s, you got that. Then you need to be very, very stupid, because you have no idea what you're getting into. Special Forces is a 9-month program. No holidays. No weekends. They drive you to the point of exhaustion. We're talking like Navy SEALs has a hell week. We have 2 weeks of hell. We're talking 20-hour days. Very physical activity, very rigorous. They drive you to the point of physical exhaustion. And when they do this, they want to see how are you operating mentally. What can you recall? What can you recollect? There were 260 trainees in my section. After that 2-week period, we had fewer than 130. You go through for the next phase, and then you get into the survival, escape, and evasion phase, which is 3 weeks. And you got 4 weeks of exercise, and we lost another half. You're going to find out what your discomfort level is real quick. Upon graduation, out of 260 candidates, we had 39. That's 15% graduation rate. That's average in Special Forces, 15% graduation rate. At that time, you're going to be assigned to a theater of operation, either the U.S., you're going to be assigned to Europe, or the Far East. You're going to be assigned to a 12-man team. You're going to do reconnaissance missions that are very sensitive, and some that are only authorized by the President of the United States. You're going to do hostage rescue. And I can tell you right now, when you go in a hostage rescue situation, if there's a family involved, mom's not going to leave the children. And also, too, you do training missions, or like rebel units and forces that are, say, under the dictatorship of such government. So what all my training has done is helped me to look for detail. You got to stay alert. So that has really helped me being a commodity fund manager. I look for things out there maybe other people are not looking for. Same thing with being a commodity consultant. I got clients in the U.S., Canada, grain producers, hedge fund managers, professional traders. When I got started back in the, say, 80s, things were real simple. Fundamental analysis is pretty much the key. Just old meat and potato analysis. looking at weather, crop reports, cattle on feed, egg sets and so forth, basis levels, carrying charges. Conrad Leslie, who was with Thompson McKinnon, was probably the most well-known analyst at the time. When he made a crop prediction, it usually had an impact on the market. You had Sparks Commodities, now known as Informa Economics. Whenever they made crop projections, it had an impact as well. Refco was a very large brokerage firm. They were a boutique for large traders. You have a house, for instance, or a trader, he may be doing 200 or 300, 400 lots of beans. Refco would be clearing for them and so forth. You had the trade with these, thinking, who's doing this? What big professional trader clearing these trades? Or is it a large commercial firm just trying to disguise what they're doing? Rich Dennis was one of the largest professional traders at the time. Paul Tudor Jones was really the first true systems trader that we had to use technical analysis. Pretty much life was simple back during those days. Well, we're going to fast forward to 2001. We're going to start paying attention to detail here because this is when these markets started to trade. They're starting to change. Dollar index peaked July 2001. The Dow Jones during that period was approaching 12,000. Look at the trend we had from the 70s. With the dollar peaked, large institutional investors were looking for growth in inflation. They took some money off the table in stocks and started to look at commodities. First place they started to look. Gold market. Gold market. 2001 was about $250, $255 an ounce. In about a 3 to 4 year period up into 2004, it had doubled in price. The next market they looked at, the large traders, crude oil, about $15, $20 a barrel. 2004, it doubled pretty much at $40 a barrel. Of course, it shot up to 145, and when the financial crisis hit, fell to 35 and since recovered. What about the grains? Let's don't pay attention to detail real close here. 2001, when the dollar peaked, corn was about $2 a bushel. It moved up to 3 1/4, but that wasn't anything really got anybody's attention. Corn had been up to $5 in '96. Something happened here in the fall of 2005. What was it? Corn prices started to go up, as well as the other grain prices. Oh, ethanol got the attention. Ethanol was the reason it went up. Go. CFTC, Commodity Futures Trading Commission, increased the position limits on all grain commodities, and I'm just giving corn as an example, from 9,500 contracts to 22,000. That's a 230% increase. When I saw that announcement, my jaw dropped open. This is when your market started to change. Other traders I talked with, we knew these markets weren't going to be the same. You can see what the grain markets have done. That was the start of it. It also was the start of growth in the speculative industry. Trend following funds. What are they? That's a fund that can go long, short to market. I managed a trend following fund with a firm in the Southeast. Did it for 12 years. That's as close to riverboat gambling you're going to ever get. I didn't get a salary. I got a percentage of the profit. That was it. I traded the grains. I traded the meats, cotton, traded bonds and currencies in the portfolio that I had. These funds trade long-term, medium-term, short-term price moves. System I use, traded more medium term. I was in the market, well, I'll take that back. I'd be in the market maybe 3 days. I've been in the market as long as 6 weeks, depending on what my system shows. You got some of these firms that they'll trade all 3 systems. In other words, they'll have a long position on corn to carry for months, and then they might get a short-term sell signal, which they sell a contract other than the one that they're in, just to take short-term counter-trend move. 80% of these are technically based. They don't look at weather. When I traded bonds, I didn't look at money supply. Care less about it. Looked at the trend. Only 20% of these funds are fundamentally based, and they're not pure fundamentally based either, because they use a lot of technical analysis in placing their trades. They do not forecast prices. They wait for a trend to develop, and then they jump on both. You know, grain producers, if you've ever been around them, you know, they try to pick tops and bottoms in the market and so forth. Fund traders don't do that. They wait till the trend becomes established. They just want what's in between the top and the bottom. Most of them use a moving average type system, a relatively simple system. Some use channel breakout or a combination. System I use, I still use today when I make my cash grain recommendations. It's basically a combination of the Elliott wave system, use the moving average for a filter, and a couple of momentum indicators. So we had huge growth in these trend following systems when the dollar peaked. Another area we had big growth, index funds. Index funds gained popularity after the dollar peaked. And these are just funds that are invested in a fixed basket of commodities. Be the energies, of crude oil, unleaded gas, natural gas, metals. You got your precious metals, gold, silver. Also, you got your base metals, lead, zinc, nickel, and so forth. And then the ag markets. Now, they were not initially developed to be an investment vehicle. They were developed by investment banks to track the performance of commodities during the 70s and 80s and also track inflation. They've grown from $5 billion in 1990 to over $500 billion today. Mostly the pension funds and endowment funds, the big money, are the ones that are in it. Now, pension funds, they don't care what wheat's doing. They don't care what cattle's doing. They may, have an opinion on gold and crude or the energies, but they definitely got an opinion on inflation. They are investing for inflation. They will probably take maybe 2, 3, 5% of their portfolio and put it in the commodity fund index. And these are your 5 top indexes here. They're pretty well weighted equally, like in the grains in most commodities. Some of them may be weighted a little more heavily in the metals. I know that Goldman Sachs is more heavily weighted in the energies. So if I'm, say, a portfolio manager pension fund and I have a positive outlook on energies, I may have a little more committed in the Goldman Sachs index. So you got 2 things here that have changed. Trend following funds and also index funds. We got a new kid on the block, though. Heard of high frequency trading? This is nothing more than Pac-Man trading, like a 10-year-old kid. High frequency trading is a high-speed automated trading platform. When I enter orders electronically, I use a trading platform. I actually use the RAND system. And that's all I use it for, to enter orders. These high-frequency trading platforms, they can transact hundreds, thousands of orders, not in seconds, but in milliseconds. They're used by your large banks, hedge funds, and institutional investors. Now, they take it a little step further than just entering orders. These computer systems, the software they have, they can scan multiple markets in seconds to spot emerging trends. So let's say, for instance, you've got a stock index fund. You've got, say, some of the stocks in that fund might be deviating from what they normally do. That high-frequency trading system will automatically go in, buy those stocks. They may hold them for just a few minutes, seconds, and boom, they're out. The speed they have, or the big advantage they have over traditional platforms, are the speed. It's just kind of give you an idea. If you're like listening or watching a football game on TV, you got the sound muted, you hear a touchdown was scored, and just a few seconds later, you're going to see it on TV. That's the way this operates. These high-speed systems, they will see the bids and offers before traditional platforms will. These firms have no physical interest in commodities traded. They implement short-term trading strategies. It's just going to be held for a few seconds or a few hours. They're flat at the end of the day. They're in and out of positions. I've seen them where they trade back and forth as much as 1,000 times a day. This has a big impact on the market. They can have like a destabilizing effect, create bubbles. The May flash crash was a perfect example. 70% of your stock trading today is high-frequency trading. It's not from the mutual funds, not from T. Rowe Price, Fidelity, high-frequency trading. And 30 to 40% of all commodity trading is done by high-frequency trading, and it's growing. CME in 2011, over 30% of their revenue came from high-frequency trading. What problems can it cause? How many of you have ever operated a computer from your computer and it goes down for whatever reason? You got a problem. Software problem. Same thing happens with these. May flash crash was a perfect example. These systems, kind of like a herd, they kind of run along with one another. So if you have a computer problem with one, it's going to have an impact probably on the others as well. Another problem is, can you imagine what could happen to the trading on exchange if a hacker got in one of these? The regulators don't know what to do about these systems. They can't really classify them because when you put on like an order like you're going to be classified by hedge or spec account, if you're flat at the end of the day, there's no way they can classify you. And the CFTC report comes out every week. Here's where I think our next big problem. Derivatives explosion. Remember Lehman Brothers? MF Global? We're talking tip of the iceberg. Derivatives are nothing more than futures, options, swaps, interest rate, currency swaps, leveraged investments. The over-the-derivative or over-the-counter derivatives pose the biggest risk because they're not regulated. Regulated derivatives pose risk as well. The reason they've grown, interest rates are zero. You got these banks now, investment banks, that they can't get yield. So what they do, they go in the derivatives market, trying to gain profit from them using derivatives. Derivatives markets globally have grown from 600 trillion to 1.2 quadrillion dollars. You're looking at the global GDP of 65 trillion. That's 10 to 20 times the size. You got four major banks have exposure of $235 trillion. JP Morgan, exposure $78 trillion. Total assets $2.2 trillion. Their leverage 35 to 1. Look at Goldman Sachs' leverage, 48 to 1. I can tell you for this professional trader, when you get above leverage of 10 to 15 times, it's excessive, you're going to get in trouble. I'm going to throw a little scenario out. What if each one of these firms had 2% of their derivatives went toxic? We're talking $10 trillion. U.S. tax revenues average 2.4 trillion. You think the FDIC could come in and back it up? No way. How did this happen? What about the Dodd-Frank bill? Isn't that supposed to protect us? Barney Frank doesn't even know what's in the Dodd-Frank bill. This happened when they repealed the Glass-Steagall Act in 1999. Our grandfathers and great-grandfathers, when they went through the Depression, they knew it's because of excessive use of speculation. The Glass-Steagall Act was legislated to separate the practices between commercial lending banks and investment banks. When they repealed it in 1999, it allowed these investment banks to come in and to gobble up these commercial lending banks. Well, you've got these derivatives positions are protected by the FDIC. This is, I think, could be our next bubble. Of course, Denver Name could be here when I go over this. How many of you put much confidence in these Department of Commerce reports, labor reports, and so forth? Well, I don't either. I can tell you this, the training as an economist, I also work in the government. You know, you have reports that come out and, man, we can't put that down. Well, what they do, they look at their models, and they go back and they change the variables in their models. Oh, this looks better. We'll put this out. I look at two things. Well, first of all, I look at one thing. I look at what the trade associations put out. The trade association has no axe to grind. None whatsoever. First one I look at to get an idea of what the global economy is doing, I look at the Baltic Dry Freight Index. What that is the shipping rates of various size containers. They're either going to Europe or they're going to, say, the Far East. Now, when the economy is strong, you can expect them to be more expensive. Before we had the financial crisis, they were. Before they dropped here back in 2009, and they just more or less have just gone flat. Look at 2012. You got flat rates. So your global economy basically stinks. I think another one to gauge the domestic economy. You know, the pulse of this country runs on labor. The cars are loaded each month. In the peak year of 2006 of our economy, we were loading between 340 to 320,000 rail cars each month. Strong economy. Financial crisis hit, fell to 250,000. 2011, 2012 rebounded a little bit. 2012, you would be led to believe our economy was doing better in 2012 than 2010 and 11. You can see the shipping or rail car loadings are less. I look at these individually too. When you have strong manufacturing, you're going to be using more coal. Year over year, rail car loadings of coal is down nearly 14%. Cumulative loadings are down 10%. Also, when you have strong manufacturing, you're going to be having more waste material involved for the manufacturing process. Iron and steel scrap down 25% year over year last year. 5% cumulative. Non-ferrous scrap down 13% year over year, 5.5%. When you lump all these together, our economy is supposed to be improving over the previous year. Rail car loading show we're down about 3%. Look at your miles driven. Off 4% and 2%. So our economy, or not our economy, well, economy's changed too, but these markets have changed. The days of just going out and just looking at exports, supply, demand, and so forth are over. You have got the growth in the trend following funds, the index funds. You've got the growth in high frequency trading. And like I showed you there, 70% of stocks traded are high frequency and 30 to 40% of commodities. And it's growing. These markets are a casino, I can tell you that through the eyes of a professional trader. Any questions? What questions you got? Yes?
As farm broadcasters, how are we supposed to take this information to our listeners? Obviously, we're able to look at the charts and graphs, and we heard earlier this morning visual learners. How can we relate this information, in our individual programs to help our, obviously it comes back to the farmers who are selling corn and soybeans and the livestock and things like that.
Okay. Well, it's going to be hard. Really, we have to re-educate because these grain producers, I'm not going to take anything away from the extension economists, but they in a nutshell, it's hard for them to grasp what's going on because of the changes. What I do when I write my market letter, I put in like what the funds are doing and what I think they're going to be doing and so forth. And I also make mention to like these real car loads. We're talking about most of our industry is still working under the same premises back in the 70s and 80s, and it's changed. It's going to be a long educational process. I think you have to look more at like farm broadcasting, to look at the CFTC reports and say, you had your trend following funds sold 200 million bushels of corn last week. Their long positions at the lowest level has been since July. I mean, you kind of have to do that, You got to have to get the wheels rolling in order to sort of re-educate them. After a while, they'll pick it up. But it's going to be a hard process. Ain't going to be easy. What else?
Since we're moving further and further away from a base fundamental market to a more equity-driven market, volatility will continue to be awfully high in this. So what brings the market back to a fundamental base? Or will we ever get back to a true fundamental base of the market?
I don't think so. I think if we have, like, for instance, a derivatives explosion or implosion, I think that's going to drive a lot of big investors out. I'm through, I'm done with these commodities and so forth. Then we may get back more to a fundamentally based system, but I don't think we'll ever get back there.
But will the commodities ever remain attractive because of the basic needs of human beings, do you think?
They will.
But not to the same degree.
Not to the same degree. The old saying is, you think, well, everybody's got to eat. I'm going to tell you something. My experience in the military, no, you don't. Those are the hard and cold facts of life. Like I said, I look for these markets through different eyes.
Thank you.
How does your vision on the market, if everybody makes decisions based on their experiences or how they relate to it, so how do you convey that type of a message, whether you're interacting with us as farm broadcasters or you're interacting or speaking to farmers and help them to engage and maybe look at things from a different angle and not look at it inside the box, but maybe outside of the box a little bit?
Well, I do that in my market letters. I mean, in my market letters, well, first let me just say this. When I called in, when I was in the military, I called in an artillery round. Two things I wanted to know, or two things I had to know. I had to know where they were. Just know where you are. You might call it in on yourself. And the methods I use in forecasting are, I want to know, like for instance, where these prices are going. I even use cycles to determine like when I think markets are going to top and bottom, long term, short term. Are they accurate 100% of the time? No, they're not. But at least they kind of give me ideas, and I relay these in my, into my market letters and so forth. And I have actually found out that I have been working with some people, tutoring them, not knowing the potential. This is what I'm doing, but I, say, hey, you need to look at this. You need to look at that, And it's just, it's going to be a slow process. Your younger group of grain producers are going to grasp to it more quickly because they're more technically savvy. The old guys, not going to happen.
How much does that change what you guys do? Whether it's moving away from open cry.
I'll tell you, the pits are dead now as far as the actual trading pits, with the exception of options. Options trading is really the only thing that's pretty much saved the bacon of the pits. And the reason being is that options can be very, very complicated. And I can tell you, when you put an order in using options, the computer doesn't really know what you're wanting to do. I mean, the bid offers on some of these strikes may be way, way out of whack. You got that guy floor broke from the other end. Say, I need to do this. He says, let me get you a bid offer quote on each side you're doing. You know right away. I'm going to tell you, if you use electronic trading and options, you can be raped in a hurry. So I think that will keep the pit open, but as far as actual futures trading, it's pretty much all electronic. About 10% of actual pit trading now in the futures.
How quick has that change been?
Probably it's been real quick within the last 5 years.
Anybody else have questions?
Just one final quick question.
Yeah.
This transition now for the Kansas City Board of Trade to the CME group.
Mm-hmm.
Any thoughts looking forward on that?
It's not going to change anything.
Okay.
They may throw out a couple more products. We got too many products out there. And like if you get some of these large investment banks get involved in like some of these products, there's not enough liquidity. That's where the problems come.
Thank you.
Have you had a chance to look at today's report?
Mm-hmm.
Some quick thoughts looking at it.
The trade was looking for a negative report. They got it. Maybe a little more negative in beans than they were thinking. We did break some important support areas in the beans. Can they be repaired? Yes, they can, but we need to do it first next week. We took out some lows in beans that I felt should have held. We didn't take them out by a great deal. If we rebound, we could probably mend the market fairly quickly. I did notice where they did raise exports in beans by about 80 million bushels. So I'm sure they can raise another 120. Yes.
The derivatives implosion that you're talking about are possible. All the leverage there. Is that going to be like the housing market debacle, and how soon do you see that clip coming?
Well, it could come fairly quickly. All you got to, Lehman Brothers, you didn't know what was going to happen until it was already there. Same thing was with MF Global. You're probably not going to get a bunch of a heads up. You're just going to read one night where, JP Morgan or Citibank got some toxic derivatives. And the thing is, in these large investment banks, when you got one cockroach, there's usually another one. Anything else?
Again, we appreciate your thoughts and taking some time to spend with us this morning. Please look